Hi class, let's take a look at problem 33 here in chapter 7, dealing with distributions coming out of current and accumulated E&P. So the effect of that distribution, the classification of that distribution, we will take a look at and how it affects the individual receiving. Just a reminder, assuming this is a non-liquidating distribution, so in other words, the corporation is still in operation, the shareholder is still an owner after the distribution. Remember, for C corps and for the individual, the distribution can be treated as either income, whether it's ordinary or dividend income, a tax-free return of capital, or a capital gain. So keep that in mind as we look through here. And remember, if a C corp wants to distribute a dividend from a tax perspective, so similar in logic to financial accounting, how you have to have a positive balance in retained earnings. Retained earnings is all the accumulated profits that have not yet been distributed. Same logic from a tax perspective, but instead of looking at the retained earnings, for tax purposes, we look at current and accumulated earnings and profits, that E&P account, and they have to have positive balances in those accounts in order to distribute a dividend. And remember, E&P, those are the economic earnings available for distribution. So again, essentially the cumulative profits. We have a current E&P account and accumulated E&P account, and those are important because the order matters as far as how we classify a distribution and which account it comes from. Generally, it comes from the current E&P account first. Then, if that's exhausted, a distribution would come from the accumulated E&P. And undistributed current E&P is added to accumulated earnings and profits at the end of the period. With respect to E&P, remember, it's computed by adjusting taxable income, so it looks more to the economic results as opposed to the tax law. In essence, what they're trying to do here, it's more of the wherewithal to pay concept. They want to make sure that a company has the actual funds to distribute a dividend. So the E&P calculation is closer to a cash perspective of profit and loss, as opposed to a tax legislation, which is taxable income. So in adjusting taxable income to E&P, we include certain income that is excluded from taxable income. So one example would be the municipal interest. We do receive cash flow by getting interest from municipal bonds. So from a wherewithal to pay principle or perspective, we can pay that out in the form of a dividend. So we include that in E&P, whereas in taxable income, we don't. We disallow certain expenses that are deducted in computing TI, taxable income. We deduct certain expenses that are excluded from the computation of taxable income, and we defer deductions or accelerate income due to separate accounting methods required for E&P purposes. So again, realistically, what we're doing here is we are trying to see how much they actually can pay out based off of the economic activity of the period and up until that point in time. So with that in mind, let's look at problem 33 here. Hawkeye Company reports current E&P of $300,000 this year and accumulated E&P at the beginning of the year of $200,000. Hawkeye distributed $400,000 to its sole shareholder, Ray Kinsella, on December 31st of this year. Ray's tax basis in his Hawkeye stock is $75,000. So the part A asks, how much of the $400,000 distribution is treated as a dividend to Ray? So this is from Ray's perspective. Remember, Hawkeye has to have at least $400,000 in E&P for this dividend to qualify, or for this distribution, I should say, as a dividend. In this case, they have current E&P of $300,000. They have accumulated E&P of $200,000 as of the beginning of the year. So total E&P would be 500,000. So it's clear they have more than enough E&P for this distribution to qualify as a dividend. So it's not going to be tax-free return of capital or a capital gain from Ray's perspective. So from Ray's perspective, Ray will report all 400,000 as dividend income. And again, the reason being, E&P is much greater than the distribution. Part B asks, what is Ray's tax basis in his Hawkeye stock after the distribution? Simply, Ray's basis remains the same, remains 75,000. There is no distribution, there's no liquidation of Ray's basis here. The distribution Ray received was not greater than the E&P of Hawkeye. Therefore, this is not deemed a tax-free return of capital. This does not result in a capital gain to Ray. All the distribution was a dividend. So this is ancillary to Ray's basis in his stock in Hawkeye. So the Ray's basis remains the same at 75,000. Part C asks, what is Hawkeye's balance in accumulated E&P as of January 1 of the next year? So accumulated E&P, how we calculate that, I'm going to try and write a formula for you here. It's current E&P plus accumulated E&P as of the beginning of the year, or I should say beginning E&P, and then minus any distribution, minus any dividend distribution. So again, for our purposes, this problem, current E&P at the beginning of the year was, or for the year, was 300,000. Accumulated E&P, was 200,000, and we had a distribution of 400,000. So we should get accumulated E&P as of the beginning of the next year of $100,000. And again, that makes sense because we had total E&P of 500,000. The distribution was deemed as a dividend because it's less than this 500,000. So this 400,000 comes out of accumulated and current earnings and profits, reducing it from $500,000 to $100,000.